Let's start with the first way people usually invest in the market, by putting their money in the S&P 500. This is the oldest index and is comprised of the largest 500 companies in the United States, ranked by market capitalization. There are many ways you can invest in it, but for the purpose of this video, I will simply pick one of them, the Vanguard ETF VOO. For my European friends who don't have access to that ETF, you also have a lot of options to choose from. Here is the biggest and most popular one, the iShares Core S&P 500 UCITS ETF. The S&P 500 has returned on average a little over 10% since 1957 and be even more attractive 12.6% in the past 10 years. When it comes to volatility, using standard deviation and beta, which are both metrics used to assess the fluctuation of an investment return and price, we can see that for the S&P 500 for the past 10 years, they are 15.63% and 1 respectively. Now, the beta metric is normal to be 1 because it is a measure of volatility that is compared to the S&P 500 index. A number higher than 1 means the investment is more volatile, while a metric less than 1 means it's less volatile. Since the S&P 500 cannot be more or less volatile than the S&P 500, that would be a kind of inception. It's always going to be 1, but we will use it for our next ETFs. The fees for owning this fund are as low as it gets, with Vanguard charging 0.03%. And now let's look at the top companies. The top 10 ones make about a third of the fund at 32.5%. We can see the familiar USA big tech corporations, plus Eli Lilly and Warren Buffett's holding company Berkshire Hathaway in them. So as you can see, the fund is pretty top heavy, and for every dollar you put in it, about 30 cents will go to these top 10 stocks. Now, here it is important to understand that the beauty of the ETFs is that they are self-rebalancing and cleansing, so to speak. The top 10 companies right now have nothing to do with the top 10 companies 30 years ago and will probably have nothing to do with the top 10, 15 years from now. I found this wonderful graphic at the website personalfinanceclub.com that shows what the companies were in 2000. As you can see, the only one that remains today is Microsoft. And looking back at the index in 1973, it is totally unrecognizable. Not a single one of them is in the top 10 right now. As you can see, this is the benefit of investing in index funds for the investor who doesn't want to try to constantly predict which stocks will outperform in the next decade. Lastly, looking at the sectors inside the S&P, we can see an obvious domination by the tech sector at 30%, followed by financials and healthcare with 12% each. This is just a part of my video about investing in the so-called market. To watch the full version, click on the video that should have appeared on your screen.